While the market tries to recover from the shock of April 2025, a bigger crisis is quietly unfolding in the global financial system, one that could erase trillions more in wealth. And the warning signs are eerily similar, and in some cases, far worse than what we saw just before the 2008 collapse. We just lived through a jarring reminder of how quickly things can unravel. The April crash, triggered by new US tariffs, wiped out over $6.6 trillion in global market value in just 2 days. Yet, the headlines are already trying to move on, focusing on any scrap of good news. But beneath the surface, the bedrock of the entire global economy is cracking under the weight of an unprecedented mountain of debt and inflated assets. Most people aren't paying attention. They see a small rebound and assume the worst is over. But the gap between what investors want to believe and what the underlying data is screaming has rarely been wider. This isn't about fear mongering, it's about recognizing the pattern. It's about understanding that the same forces that triggered the last great financial crisis are not only back, but they're on steroids. What we're about to break down are the red flags the mainstream narrative is conveniently ignoring, and why you must understand them to protect yourself from what's likely coming next. The first and most terrifying warning sign is a number so vast it's almost incomprehensible: global debt. As of mid 2025, the total global debt, that's government, corporate, and household debt combined, has soared to around 315 trillion. Projections from the IMF show global government debt is on a path to hit 100% of global GDP by 2029, a level not seen since the world was rebuilding from World War II. Let's try to put that number in perspective. If you were to spend $1 million every single day, it would take you over 860,000 years to spend $315 trillion. That's a weight the global economy has simply never had to carry before. This isn't just some abstract figure for economists, it's a ticking time bomb made of three distinct parts. First, you have government debt. Countries around the world, including the United States, borrowed at a historic pace, first to survive the pandemic and now to fund everything else. For decades, the theory was that you could borrow your way to prosperity. But now the bill is coming due. Higher interest rates mean the cost to simply pay the interest on that debt is exploding, crowding out spending on everything else. This creates immense fragility. Any new shock to the system and the ability for governments to step in and save the day is more limited than ever. Second, and perhaps more dangerous right now, is corporate debt. Over a decade of rock bottom interest rates was a paradise for companies. They borrowed unbelievable sums for next to nothing. But this created a sickness in the economy: the rise of zombie companies. These are businesses that don't actually make enough profit to cover their own interest payments. They only survive by taking out new debt to pay off the old debt. It's a financial merry-go-round. The private credit market that helps keep these zombies alive has ballooned to over 2 trillion. What do you think happens to these companies, these employers of millions, now that cheap money is gone? They can't refinance. They are the walking dead of the economy, and when they start to fall, they'll trigger a chain reaction of defaults. Finally, there's consumer debt: mortgages, auto loans, credit cards. While private debt has seen a slight dip as a percentage of GDP in some developed nations, the overall pressure is immense. Delinquency rates on credit cards and auto loans are ticking up, a clear sign that households are struggling under the weight of higher prices and borrowing costs. People are running out of runway. This isn't just a pile of debt, it's a supernova of debt radiating instability. It's the fuel for the fire to come. The second major warning sign is what many have dubbed the everything bubble. When central banks pumped trillions into the system and held interest rates at zero for a decade, that money had to go somewhere. It went everywhere. It ignited a speculative fever that has pushed the prices of nearly every asset to unsustainable, logic-defying highs. Let's start with the stock market. One of the most reliable long-term valuation metrics is the Shiller PE ratio, also known as the CAPE ratio. It gives a clear picture of whether the market is cheap or expensive. Its historical average is around 16 or 17. Right before the 1929 crash, it hit 30. Before the dot-com bust in 2000, it peaked at 44. Just before the 2008 crisis, it was around 27. As of late 2025, even after the recent drop, the Shiller PE ratio is hovering closer to 37. We are still in nosebleed territory. But it's not just the valuation, it's the concentration. The S&P 500's performance has been driven by a tiny handful of mega-cap tech stocks, the Magnificent Seven. As of mid-2025, These 7 companies made up a staggering 34% of the S&P 500's total market value. That level of concentration has no historical precedent. Think about it. The health of the index representing the entire US economy is dependent on just 7 companies. If only a couple of these giants falter, they could drag the entire market down with them. That's not diversification, it's a house of cards. This bubble mentality has bled into other assets too. The housing market remains incredibly unaffordable for the average person. We've seen speculative manias in cryptocurrencies, meme stocks, and collectibles. The psychology is the same, a belief that prices only go up, totally disconnected from underlying value. This is what bubbles do. They warp our perception of risk. The Warren Buffett indicator, which compares the total value of the stock market to the country's GDP, recently hit over 200%. For context, just before the dot-com crash, it peaked at 140%. Relative to the real economy, the stock market has rarely been this expensive. It is a glaring, flashing red light. If debt is the fuel and the asset bubble is the bomb, the third warning sign is the cracks appearing in the foundation of the financial system: the banks. Most people assume the banking crisis of 2023 was solved. It wasn't. It was papered over. The core problem still exists. US banks are sitting on hundreds of billions in unrealized losses. In the second quarter of 2025, that number was over $350 billion. These are losses on all the safe government bonds and mortgage-backed securities they bought when interest rates were low. Now that rates are higher, those older bonds are worth much less. These aren't theoretical losses. They're very real. They're only unrealized because banks haven't been forced to sell yet. But it means hundreds of billions of their capital is frozen in losing positions, choking their ability to lend. It makes them incredibly vulnerable. If depositors get nervous again, as we saw with Silicon Valley Bank, these banks would have to sell those bonds at a massive loss, which could make them insolvent overnight. And this brings us to an even bigger threat: commercial real estate, CRE. With the rise of remote work, office buildings across the country have record high vacancy rates, over 20% nationally in early 2025. The value of these properties has plummeted. The problem is that a massive wall of CRE debt, estimated as high as $950 billion, needs to be refinanced in the next year. Who holds that debt? A huge amount is held by the most vulnerable parts of the system: regional and local banks. They're facing a double-edged sword. The property values securing their loans have collapsed, and the borrowers can't refinance at today's high rates. This is a slow-motion train wreck that threatens a wave of defaults, putting immense pressure on the very banks already weakened by those unrealized losses. Then there's the shadow banking system, the vast multi-trillion-dollar world of private credit funds and non-bank lenders operating outside traditional regulation. This is where much of the riskiest lending has happened. It's a black box. No one is sure just how much risk is lurking there. It's reminiscent of the opaque derivatives that caused the 2008 crisis, a hidden source of risk that no one pays attention to until it's too late. The cracks are there. All it takes is one more shock to shatter the facade. Act 2, agitation. Why you should fear this. So, what do these big abstract numbers actually mean for you? To understand the stakes, we just have to look back to 2008. The parallels are chilling. Before 2008, we had a massive credit bubble in the housing market. Today, we don't just have a housing bubble, we have an everything bubble. Credit has been funneled into corporate bonds, private credit, and government debt on a scale that dwarfs what we saw back then. Before 2008, complex instruments were thought to have eliminated risk. Today, we have a multi-trillion-dollar private credit market that is just as opaque. The names have changed, but the game is the same: hiding risk where no one can see it. Before 2008, regulators were asleep at the wheel. Today, the narrative is that the market is strong, even as that strength relies on a handful of tech giants while the rest of the market stagnates. The watchdogs are again cheering on the party instead of checking the foundations. Now, let's make it personal. Think back to what happened to ordinary people in 2008 and 2009. People who had spent 30 years saving for retirement watched their 401ks get cut in half. Imagine opening your statement and seeing that $500,000 you had saved for your golden years was suddenly $250,000. The dream of a comfortable retirement replaced by the nightmare of having to work another decade. Millions lost their jobs. The unemployment rate doubled to 10%. These weren't just factory workers, they were architects, lawyers, IT professionals. People with safe careers were suddenly standing in unemployment lines. The housing market collapsed. Foreclosure signs popped up like weeds on suburban streets. That was the reality. That was the human cost. And the warning signs today suggest the next phase could be even more severe. Let's move from the past to the immediate future. If another crash of that magnitude were to happen, what would it look like for you right now? First, your savings and investments. In 2008, the S&P 500 fell over 50% from its peak. In the dot-com bust, the Nasdaq lost nearly 80%. When you hear analysts talk about a major crash, it sounds insane, but it's not without precedent. Let's run the numbers. If you have a $500,000 portfolio, a 50% drop means you lose $250,000. Decades of saving, gone. The financial security you thought you built is decimated. For a young person, a crash like this can be psychologically devastating, scaring them out of the market for years. Next, your job. When a real crisis hits, companies go into survival mode. Their revenue plummets, credit freezes, and they slash costs. What's the biggest cost? Payroll. Mass layoffs become unavoidable. It starts in tech and finance, but it spreads. No one is safe. The company you've given years to might see you as a line item on a spreadsheet that needs to be cut. Suddenly, your stable income is gone. Then there's your cost of living. The terrifying scenario many economists worry about isn't just a recession, but stagflation, a stagnant economy with high unemployment and high inflation. So not only might you lose your job, but the cash you do have buys less and less. Your income goes down while your expenses go up. It's a recipe for widespread financial ruin. Finally, there's the psychological toll. The sheer stress and anxiety are destructive. It drives people to make catastrophic decisions. The number one mistake investors make is panic selling at the bottom. They watch their portfolio shrink, can't take the pain, and sell everything, locking in their losses permanently. Fear makes you your own worst enemy. This is why you should fear the next crash. Not to be paralyzed by it, but to respect the damage it can inflict on your portfolio and your entire way of life. Look, I know this is intense, it's unsettling, but if you're finding this breakdown valuable, take a moment to subscribe. We're in this together, and the first step is understanding the battlefield. One of the most dangerous beliefs is that a crisis can be contained. We heard it in 2007. The subprime problem is contained. We heard it again just before the April 2025 crash. Commercial real estate issues will only affect a few regional banks. The April crash proved how wrong that was. In our hyper-connected global economy, financial contagion spreads like wildfire. The crisis in April, sparked by US tariffs, wasn't just an American problem. Panic selling began on the NYSE, but within hours, markets in Tokyo, Hong Kong, and London were plummeting in response. The dominoes fell, one after another, circling the globe in days. It was a live demonstration of how a single trigger can ignite a global firestorm. And here's the most critical point. The old safety nets might not work this time. For 40 years, investors relied on the Fed put. The Federal Reserve would ride to the rescue, slashing interest rates and pumping trillions into the system. But what happens when the Fed is trapped? What if, when the next leg of the crisis hits, inflation is still stubbornly high? If they cut rates and print trillions to bail out the system, they risk igniting uncontrollable inflation. If they keep rates high to fight inflation, they risk letting the debt-laden financial system collapse. It's checkmate. The sheer scale of global debt means the size of any required bailout would be astronomical, far larger than in 2008. Governments, already buried in their own debt, may not have the fiscal capacity or the political will for another round of massive bailouts. The public appetite for bailing out the institutions that caused the crisis is gone. This is the nightmare scenario, a crisis that spreads globally with central banks and governments unable or unwilling to stop it. This time you may truly be on your own. Act 3, the solution, how to protect yourself. Okay, it's a grim picture, but it is not hopeless. Fearing the crash isn't about curling up in a ball, it's the motivation to take action. Panic is not a plan, preparation is. Now we pivot to the solution. There are concrete steps you can take, not to time the crash, no one can, but to build a financial arc that will let you ride out the storm and even come out stronger. Step 1. Build your financial fortress. Cash is king. In a world drowning in debt, cash is clarity. In a market crash, cash is not just defensive, it's the ultimate offensive weapon. While others are forced to sell their best assets at fire sale prices, the person holding cash has the power. Your first step is to build a significant cash reserve. The old rule was 3 to 6 months of living expenses. In this environment, you should seriously consider expanding that to 9, 12, or even 18 months. This is your fortress. It's what lets you pay your mortgage and buy groceries if you lose your job, without having to panic sell your investments at the worst possible time. Think of this cash in 2 parts. Part 1 is your emergency fund, in a high-yield savings account, completely safe and liquid. Part 2 is your dry powder, an opportunity fund, When the next crash comes and quality assets are on sale, this is the money you'll use to buy. As Warren Buffett said, be greedy when others are fearful. Cash lets you do that. Step two, de risk and diversify your portfolio, for real this time. For the last decade, you could own almost anything, and it went up. That era is over. Now is the time to look at your portfolio with a ruthless and honest eye. True diversification means owning a mix of assets that don't all go down together. For most, this means reducing exposure to high-flying, unprofitable growth stocks. They will be the first to be decimated. Consider rebalancing toward more defensive sectors. Value stocks. Companies with strong balance sheets, consistent profits, and low debt, they're built to survive a storm. Bonds. While bonds have had a tough run, high-quality government bonds can still be a buffer in a deflationary crash. Precious metals. Gold and silver are assets that exist outside the debt-based financial system. When faith in currencies wavers, gold often shines. Geographic diversification. Is all your money in one country's stock market? Exploring international markets can provide a hedge against a localized crisis. If you have a 401k, log in and look at what you own. Most plans offer a range of funds. You might be able to shift assets from an aggressive growth fund into a more balanced or capital preservation fund. Taking some risk off the table now isn't market timing. It's prudent risk management. Step three, stress test your life. A financial crash doesn't just stress test your portfolio, it stress tests your life. Now is the time to fix the weak points. First, attack your high interest debt. Credit card balances, personal loans, these are anchors that will drag you underwater. Every dollar you pay in interest is a dollar you can't use to build your cash fortress. Create a budget and cut unnecessary spending. Paying down your personal debt strengthens your personal balance sheet. Second, think about your income. Relying on a single job is a massive risk. How can you become more resilient? At your current job, focus on becoming indispensable. Acquire new skills. Beyond your job, explore other income streams. Freelance work, a side hustle, even an extra $500 a month can be a game-changing lifeline. Step four, the contrarian mindset. Mastering your emotions. This may be the hardest step. You can have the perfect plan, but if you succumb to fear at the moment of panic, none of it will matter. The biggest fortunes are made by having the guts to act rationally when everyone else is losing their minds. You must forge that mindset now. The way to do this is to create a written plan, not in your head. Write it down. If the market drops by 20%, I will rebalance. If the market drops by 40%, I will deploy 25% of my dry powder cash into my target list of stocks. Having this pre-written set of instructions is your defense against your own panicked brain. When the headlines are screaming and your gut tells you to sell, you don't have to think. You just execute the plan you made when you were calm. Study market history. Crashes feel like the end of the world, but they all end. And they are all followed by opportunity. Your job is to make sure your ship is still afloat when the storm passes. Step 5. Identify asymmetric opportunities. This final step is what separates survival from triumph. A market crash is a tragedy for the unprepared. For the prepared, it's the greatest wealth creation opportunity of their lifetime. It's a massive transfer of wealth from the over-leveraged and panicked to the liquid and patient. Your job now is not to buy, but to build your shopping list. Research the highest quality companies in the world, businesses with durable advantages and pristine balance sheets. The stocks of these companies will get thrown out with the bathwater in a panic. A world-changing company might see its stock fall 60% or 70% simply due to fear. These are the opportunities you're waiting for. Look at other assets. Are there real estate markets that become deeply distressed? Are there entire sectors beaten down by recession that are poised for a massive recovery? This is about identifying bets where the potential upside far outweighs the remaining downside. You are waiting for the moment of maximum pessimism to become a buyer. This mindset is what transforms fear into fortune. The economic warning signs are a deafening siren, a mountain of global debt, an everything bubble stretched to its limit, and deep cracks in the financial foundations. The April crash was not the end of the crisis. It was the first major tremor. To ignore these signals now is willful blindness. But the point of this isn't to leave you in a state of fear. It's to jolt you into a state of preparation. The consequences of the next crash for the unprepared will be severe. However, you now have the blueprint. The storm is coming, but you don't have to be a victim. By building your cash fortress, de-risking your portfolio, stress testing your life, and preparing to seize the opportunities that chaos will present, you can protect yourself and your family. The goal isn't to predict the exact day the storm will hit. The goal is to build a vessel strong enough to withstand it whenever it arrives. In the end, preparation is power. For a deeper dive into the specific assets and sectors that have historically proven most resilient during major downturns, make sure you watch our next video. And if you haven't already, subscribe and click the notification bell. In this environment, you can't afford to miss these updates. Stay safe and stay prepared.